Hello, this is Brian Rezny, president of Rezny Wealth Management, of course, the host of the Rezny Wealth Report. We're live every Wednesday from 6 p.m., and of course, you can watch our program again on Sunday at 7:30. If you have questions about your portfolio, if you're questioning the advice you're getting, maybe you own some stocks or bonds or mutual funds, maybe you're a retiree, you've lost a lot of money in 2008, you're worried about the next correction that may be coming. How about the bond market correcting even more than what the stock market has already corrected? Can you afford to lose 30 or 40% of your income portion of your retirement portfolio? All of those questions we'll be talking about today on today's show. But again, this show is all about you, the listener. If you have any questions whatsoever about your portfolio, whether it's about a stock, a bond, a mutual fund, you want to understand how ETFs or exchange-traded funds work, maybe you want to know about annuities. Somebody's trying to sell you an annuity at a free lunch seminar, and I always tell investors, annuities are sold investment products to unsuspecting investors. Do not be taken to the bank. What I want to stress to many of our listeners is this. Before somebody sells you the next annuity, make sure you understand what you're getting yourself into, and more importantly, understand that you often cannot get your money out for 5, 10, 15 years with big penalties. We keep seeing this repeatedly from questions coming into not only our TV show, but also my live show that I do, radio show on Sundays from 10 to noon throughout Florida. Again, I'll put that number up on the screen if you have a question about your portfolio. I'll take your call live on air, or if you would rather, you can call that same number, give your question to a studio producer, and I'll take your question off air. I will also encourage you to visit our website, ReznyWealth.com. That's ReznyWealth.com. You can sign up for my newsletter. It comes out every Monday. That's free. And we also have some educational workshops coming up in April in the Fort Myers area. It's called Adapt or Fail. This is going to be my tell-all investment workshop for retirees and pre-retirees. But again, I'm going to take your call right now in the studio at 239-417-4711. I want to bring up a quick little chart about the stock market and what we're currently seeing. This is the S&P 500. Right now, all of our primary indicators are positive within the stock market, and our secondary indicators across the board pretty much are positive. What I want to tell you is this. When you look at not only the stock market, you want to look at the stock market in the U.S., and those are broken up in 3 categories, small, mid-cap, and large. And I can tell you, based upon our proprietary strategy at Rezny Wealth Management, small, mid-cap, and then S&P are ranked on the top tier of our relative strength strategy. What we're finding is, and I'm going to talk a little bit about emerging markets and other economies around the world throughout this half hour, but one of the things that I want to stress is this. Relatively stronger investment sectors historically have outperformed over various time frames, and other weaker sectors have underperformed. We're going to talk about that also throughout this half hour. I think too often investors buy or they're sold investments that they truly don't understand without an investment strategy. If you don't have an investment strategy on how those investments relate to that strategy, which includes risk management when to sell any investment, this is really the crux of the problem with a lot of investors. They don't know truly what they should be buying because they don't have an investment strategy, and that so-called advisor is really acting in a broker capacity and they're not responsible to manage your money. Then when you buy a lot of these investments and something like 2008 happens again, your money all goes down. So again, investment strategy number 1, then based upon that strategy, which must include risk management, or when do you sell and reduce risk and take profits, that's part of the investment strategy. I want to go to my first caller. This one is in Jim from Fort Myers. What do I think about investing in emerging markets? Do you have any suggestions? Jim, I'll tell you what, we like the emerging market economies in general, but we own very little of them right now, and I'll explain why that is. In general, the emerging market economies like, let's say, Brazil, the Latin America economies, China, India, countries like that are growing at a much faster GDP growth than what the U.S. is growing at, often 3 and 4 times. As an example, Our economy in the U.S. is expected to grow about 2% this year. If you look at almost all the other emerging market economies, they're projected to grow between 4 and 8 to 10% this year alone. But that doesn't mean they're great investments right now. In fact, emerging market large cap, the bigger companies in the emerging market, are actually lagging, and they're towards the bottom to middle of our relative strength ranking when we break up various sectors of any economy. The small cap emerging market, though, is actually towards the top of our list or our ranking proprietary system. So it's interesting, just because emerging markets are a category, small right now is actually the place it's in vogue, it's in fashion, and it actually fits well in a portfolio. I'll give you one emerging market investment idea. It's symbol DGS. This is the Wisdom Tree Small Cap Dividend Paying Equity ETF. An ETF is an exchange traded fund. It owns a basket of over about 500 or 600 small cap dividend paying stocks in emerging market economies. Now again, we don't own large cap emerging market because it's been the big laggard this year, but small cap is actually doing quite well. In fact, small cap is doing almost as good as a lot of the small and mid cap in the U.S. So if I break these sectors down individually, large cap emerging market is poor. We don't own it. We don't want to own what's doing average or mediocre. We want to do what's doing the best. And small cap emerging markets right now are towards the top of our ranking system. Remember, we want to own relatively strong sectors, not relatively weak sectors. And again, we'll talk more about that throughout the hour. If you have a question like Jim, in the studio, 239-417-4711. We'll take your call live, or you can leave your question with one of my studio producers, and I'll answer it off here like I did with my last caller, Jim. I'm going to go to another call real quick. Ed from Fort Myers, what do you think about structured products? My broker thinks they are a good investment. I'm sure your broker loves structured products because his firm manufactures these products. Most brokerage firms, the ones you hear about all the time on TV that are constantly being fined and censured by FINRA, the governing agency that basically overlooks the brokers and the broker-dealers, they love structured products, Ed, because they make a whole bunch of money on these products. Structured products, and I can pretty much assure you, your broker probably doesn't know a lot of the inner workings of these structured products. He gets more sales training than he does about investment knowledge or about the actual products he's pushing on you, Ed. Structured products are highly complex, okay? They often have substantial internal cost structures to them, and they are often extremely risky. Most structured products are actually guaranteed by the full faith of that brokerage house. What that means is, if that brokerage house, Ed, goes out of business, you could lose some or all of your money. Remember, Lehman Brothers went out of business. They were the darling of Wall Street before 2008. Investors that had money in their structured products, most of those people never got their money back, or they got pennies on the dollar. Structured products may fit under certain circumstances for a small position of your portfolio. The reason your broker keeps recommending them is because his sales desk is telling them they have to sell so much structured product and push this or push that. So the advice he's given you is tainted at best. I'm not a fan of structured products. Again, highly complex. They can be highly risky. They are tied often to your broker-dealer or the brokerage firm that's selling these, and if they go out of business, you could potentially lose all or some of your money. So don't be enamored with the word guarantee. That guarantee often is only tied to the brokerage firm, and actually there's really almost no guarantee at all. I'm going to go to a short little break. I'm going to come back with your calls and your questions at 239-417-4711. And again, visit our website, reznywealth.com. I'll take your calls live, or you can give them to one of my studio producers and I'll take them off air. But again, we want to help you. We want to get your retirement portfolio back on track, and we want you to avoid the conflicts of these so-called advisors and Wall Street conflicts against you and your money. I'll be right back after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hello, I'm Brian Rezny, president of Rezny Wealth Management, and of course the host of the Rezny Wealth Report TV show every Wednesday live at 6 p.m. and we do rebroadcast on Sunday evenings at 7:30. If you miss any part of this program, you can visit my website, and usually by the next day noon we actually have this program actually will be downloaded on our website. You can watch it whenever you'd like. I'm taking your calls live, and I'm also taking your calls if you want to hand your question off to a studio producer. We always like getting questions. If you want a straightforward answer about any of your investment questions or concerns, if you want to know how to understand how to check out an advisor, how to find out if you have a real advisor or one of these fake advisors as we call them, if you want to find out how to get investment advice that's in your legal best interest, that's a fiduciary. And one of the things I want to stress to all of our TV listeners is most so-called advisors do not act in a fiduciary capacity. In fact, they don't have a legal obligation to work in your best interest. A little fact today, do some research about the firm that you entrust your money to because it's important for the benefit of your dollars. I want to go to another call real quick. Bill in Fort Myers, I own 3 MetLife variable annuities. None have done well. How can I get out? Bill, I'll tell you what, about half of the individuals that come into our offices, we have an office in Fort Myers and in Naples on this side of the state, and we have offices on the other side of the state. At least half of the people that come into our offices for us to review their portfolio because they're finally realizing after years of neglect and bad service and plain bad advice about their portfolio, half of these people have at least 1 to 5 annuities they've been sold by Mr. So-called advisor. I'm not a fan of annuities in general, and I'll give you a couple reasons. I'm especially not a fan of variable annuities. Bottom line, when you buy a variable annuity, you basically lock your money up often for between 5 to 7 or 8 or 9 years with a back-end surrender. But that's not the worst part. The worst part is the horrifically high fees. Bill, probably the reason that you didn't make money within these variable annuities for how long you've owned them is a couple reasons. The average fee that when we review a variable annuity contract when somebody comes to our office, the average internal annual cost is between 3 and 5%. 3 to 5% every year is taken away from your money. The investments in most of these variable annuities are mediocre at best. 20, 30 sub-accounts to pick from, and often these investments are mediocre at best. Then once you're sold this annuity, Mr. So-called advisor actually doesn't have to watch or manage which investments you go into, so who's really calling the timely shots? What is the investment strategy? I'm going to guarantee you, if you do not have an investment strategy you follow, you're going to have horrifically bad results with your portfolio. So, high expenses coupled with lousy investments or mediocre investments and no investment strategy is a recipe for disaster. Bottom line, variable annuities are something that should never belong in your portfolio. You can get out of these things fairly easily. You may have to pay a back-end surrender. So what you want to do is weigh how much money will I save by putting this in a cost-effective portfolio, and how long does it take me to recoup that penalty? Most often, if you pay a 3 or 4% penalty to get out of one of these annuities, you may make it up in less than a year or a year and a half just by the reduction of annual cost. So again, what I would suggest to you is you can always call our office for a consultation, Bill. We'd love to sit down with you and really show you why these annuities were never good in the first place and why you shouldn't have bought these. And we'll show you how to fix the problem so you can have a more successful retirement with your money in the future. If you're like Bill and you have a question about your portfolio, in the studio, 239-417-4711. I'm taking your calls live, or you can call that same number, give it to one of my studio producers, and I'll take your question off air. You know, one of the problems that investors face, and I get this question all the time, Brian, the person I have, he's a nice guy. He calls me every quarter. Doesn't that mean he's watched my money? Absolutely not. That quarterly phone call you get is called the sales relationship phone call. All the brokerage firms teach their guys to do this, because even though you're getting bad investment advice and you're really not having money management at all, these firms realize if salespeople call you on a regular basis, you're less apt to leave. That's not money management. That's a relationship. When you hire somebody and you entrust somebody with your money, they better have a legal best interest to work in your best interest. Let me explain. Do you understand the difference between an advisory account and a brokerage account? They sound the same, but they are totally different. When you have an advisory account, and by the way, I could pretty much assure the majority of our listeners that are listening to us today, if you're working with any brokerage firm, whether it's fee-based, whether it's fee in lieu of commission or commission, any small broker-dealer, big brokerage firm at Wall Street, an insurance person selling an insurance-based annuity product, you probably have what's called a brokerage account, not an advisory account. Let me read this disclaimer that shows up on your new account application when you signed up with that so-called advisor. Your account is a brokerage account, not an advisory account. Our interest may not always be the same as yours, but that sure doesn't sound like good language to me. Please ask us questions to make sure you understand your rights and our obligation, including the extent of our obligation to disclose conflicts of interest and to act in your best interest. The bottom part is really key. Therefore, our profits and our salesperson's compensation may vary over product over time. The SEC, Securities and Exchange Commission, mandated that every new brokerage account agreement that you, the investor, signed, if it was a brokerage account, had to have that disclaimer embedded in the disclaimer form. Did you ever read that? And if you read that, would you really entrust your money with a firm who does not have a legal obligation to work in your best interest or to act in your best interest? And what the most interesting part is, the SEC didn't allow these people to use titles that were misleading to you, the investor. They couldn't use titles like wealth manager, financial planner, financial consultant. They are actually salespeople. There's a big difference between an advisory account, which is managed money, and a brokerage account. Most investors, and I would say in excess of 90% of the people that come to our firm to talk to us about managing their money actually, that come from all these other firms, over 90% have a brokerage account and they never knew the difference. I want to go to my next question, Tom in Naples. I need income for my portfolio, but almost all bonds are paying low rates. My advisor is suggesting an immediate annuity. What do you think? Tom, do not buy an immediate annuity. We talked a little bit about variable annuities in the beginning of the show. An immediate annuity is a fixed annuity. There's basically two annuity types. There's fixed annuities and there's variable. An immediate annuity typically is a fixed-based annuity. The problem is if you think interest rates on bonds are low, you're going to get horrifically bad interest when you buy an immediate annuity. What they're going to do ultimately, Tom, is they're going to take your money today, they immediately annuitize it at today's lowest rates basically in history, and you're going to get the lowest payment in history based upon those rates. There's no escalation for inflation or interest rates if they go up 3, 4, 5, or 10 years down the road. Do not buy an immediate annuity. There's other income-oriented investments that would be suitable in an income-oriented portfolio. We get involved every day with retirees who need income, and we're able to show them how to build a proper portfolio that can generate the income that they're going to need, and not with just traditional bond investments. What I would suggest, Tom, is call my office. I'm going to put our number at the bottom of the screen there. Call our office tomorrow. Schedule a meeting either at our Fort Myers or Naples office. Go to ReznyWealth.com. That's our website, and our number's down there. Of course, 800-618-8577. Call us for a consultation. Don't wait any longer. Try not to procrastinate. That doesn't fix the situation. Call our firm for a consultation. You will be glad you did, and I could assure you there's a big difference what a real money management firm does, like Rezny Wealth Management, and then all of these other firms that are really acting in a broker capacity. I'm going to take a short little break. I'm going to come back with more of your calls at 239-417-4711. I'll take your calls live, or you can give your question to a studio producer. But again, please call me. We only have about another 12 minutes left of today's show. I want to take a few more calls if we can. We want to make sure we get you the right information so you can make better decisions around your portfolio, and you're basically not given that bad advice often that comes from these Wall Street and these salespeople selling product. I'll be right back with your calls and your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. And we're back. If you have questions about your portfolio, of course, we're getting to the tail end of today's program, but we have time for a few more questions. Please call our studio hotline right now. We'll take your questions live, or we'll take them off, or you can give your question to one of my studio producers. I want to go to a quick question from Randy in Naples. I have approximately $2.2 million in various long-term bonds. Average maturity is 15 years. What do you think I should do? Randy, I'll tell you what. The problem that you're going to have is this. If you keep these bonds to maturity and rates go up, obviously you're getting not competitive interest rates. But the ultimate problem is this. If rates move up, bond values go down. Okay, you can keep these bonds to maturity if they mature in 15 years or so. The problem is it depends what interest rates do. I would assume you've owned these bonds for a while. So again, I'm taking an assumption on this one. If you've owned these bonds for a while, as interest rates have slowly, steadily gone down over the last 3 to 5 years, your bond value's actually gone up. So when rates go down, bond values go up. It's like a teeter-totter. If you sell these bonds before maturity, you will actually get a capital appreciation. So what we would look at as an investment advisory firm, we would look at what's called out is your take-out yield, meaning if you sold these bonds now or before maturity, your take-out yield is I bought a bond for $100,000, I sold it for $112,000. That extra $12,000 adds on to the principal, so that means your take-out yield from now to maturity in 15 years might only be 1.5%. So if it's only 1.5%, is there a way that we can generate better income from other alternative investments without taking the risk of long-term 15-year bonds? I firmly believe there is. So what I would suggest is this. If all of your money's in long-term bonds, you're taking the ultimate risk. I would suggest you can also call our office tomorrow, make an appointment. Let's sit down and look at that bond portfolio. Remember, if you're dealing in a broker arena, which you probably are if you own a bunch of these bonds, your broker doesn't really understand how these things work either. So unfortunately, he's selling you bonds because you want income. You might be at the exact reverse where you need to start selling these bonds and taking an actual profit on these bonds and locking in gain and now protecting principal by doing other alternative income strategies. We can talk about that. I want to go to another quick question. Sam in Punta Gorda, what do I think about Alpine Dynamic Dividend Fund? I need income, it pays 12%. Sam, what you think you're getting paid on this particular fund is actually not what you're really making. Let me put it a different way. This particular fund is a lousy mutual fund. I would sell that fund immediately. I know it's paying a high dividend. What this fund basically does is they buy stocks before ex-dividend, and they keep churning the portfolio. In fact, this portfolio might turn over 200 or 300 times in a year. The portfolio has lousy total return. Total return is you put in 100 grand. Your principal keeps dropping as you make 12% interest. So you might be making a 12% dividend, but if you lose 5% of your portfolio each year, you're only making 7%. So again, what you have to look at ultimately is this. The total return is what is the portfolio worth versus the dividend. Add those two together at the end of the day. The fund has had a lousy performance track record. There's better places for income, and that is not one of them. I'll give you two different ideas. Look at the iShares PFF and the Alliance Bernstein Closed End Mutual Fund, symbol AWF. We own both of these in our managed income accounts, and these are far superior investments, in my personal opinion, than that mutual fund you own. It's not good. I would sell it. It's a risky fund, and it's had a lousy performance and track record. The strategy simply does not work. Let's take a quick look over here at gold, and I wanted to bring this one up and show you a quick chart on gold because I keep getting a lot of questions on gold. Bottom line is this, folks. Gold is one of these really hyped investments the last 3 years. The world is coming to an end. The fiscal cliff is happening. We got sequester. We got wars and terrorist attacks. You got to own gold. Folks, you don't have to own gold. In fact, we do not own gold, although gold is an asset category that we look at in our whole pie that we look at, or all the investments within that pie. We don't own gold now. In fact, gold as a ranking of our proprietary relative strength strategy is towards the bottom. In fact, gold is down about 7% year to date, and other assets are up 6 and 7%. What I want to stress to you is this: never buy weak investments, weak relative investments. They underperform. In fact, let me put this up. Research has shown relatively stronger investment sectors historically have outperformed. We call it the faster horse. Relatively weaker investment sectors historically have underperformed the slowest horse over various time frames. Too many investors today, unfortunately, do not understand that sometimes you are better selling a loser and moving up your portfolio into assets or asset categories that are relatively stronger. This has been an effective strategy long term. There's many documented back tests and real life use on relative strength. What I'm going to give you now is a little bit of information why it works. Bottom line, are you better off buying stocks at 52-week highs or buying stocks at 52-week lows? Most people would tell me 52-week lows because they're cheaper. Actually, statistically speaking, you're better off buying stocks at 52-week highs and holding those the next 12 months. That has outperformed actual buying stocks at 52-week lows and holding those for 12 months. Relative strength is an important aspect of portfolio management, and I firmly believe if investors look at relative strength, own relatively stronger sectors, they have a superior chance of gaining traction or growing their portfolio over multiple market cycles. If you have questions about your portfolio, of course, you can visit my website, ReznyWealth.com. I encourage you to go there. You can sign up for our newsletter. It is free. If you have questions about your portfolio, you can always email us a question. We'll answer it on either next week's TV show or our radio show on Sunday. Better yet, I stress that you call our office for a consultation. If you're unsure what to do with your portfolio, if the advice you're getting is not advice at all and not working, there is a difference. We invite you to experience it. At Rezny Wealth Management, our commitment to you is under our investment management and financial guidance. You will sleep well, you will enjoy life, and you will have less stress over your investments. Call us for a consultation. Until next week's show, have yourself a profitable week.